Hello. I'm here today to talk to you about our Marketview presentation, along with my partners Oshada and Jerry. We're here to discuss the impacts of the exchange rates between the Australian and US dollars, as well as the Australian dollar and the Japanese yen. Throughout this presentation, we're going to discuss the impacts of various macroeconomic indicators, such as inflation, interest rates, and economic growth rates, on the exchange rates between Australia, the US, and Japan. By doing so, we'll attempt to predict how these indicators will affect the exchange rates in about the next 3 to 6 months. Our presentation is as follows. It involves the impact of economic growth, interest rates, and the exchange rate depreciation on the Australian and US dollars. And we're also going to discuss the impacts of inflation, interest rate, and economic growth rates between the Australian dollar and the Japanese yen. A prediction that we have between the Australian and US dollars in coming months, which involves the relative economic growth in interest rates, involves us believing that due to lower than expected unemployment rates, higher levels of economic growth, and rapidly increasing population here in Australia, we believe that in the coming months, the Reserve Bank, which currently has the cash rate at 1.5% at a historic low, will increase the cash rate to a new 1.75%. As the cash rate will be even higher in Australia relative to the US, where it's currently 1.25%, we'd likely see the Australian dollar appreciate relative to the US dollar. This is due to investors, whether they may be foreign or Australian investors, choosing to invest at Australian banks rather than American banks, as they would likely get a greater return on their investments if they invested in Australian banks, as the interest rate is higher. Therefore, as there is greater demand to invest in Australian banks, Australian currency is required to do so, so we'd likely see an increase in demand for Australian currency. As demand exceeds supply, we'd likely see the Australian dollar increase relative to the US dollar.
That's 2 point.
Hello, my name's Oshada and I'll be talking about the exchange rate expectation. Due to the recent volatility in the Pacific as well as the increasing national debt, we predict that in the upcoming months, the US dollar will continue to depreciate relatively to the AUD, as a future drop in the US dollar is expected. Because investors are expecting a drop in the US dollar in the future, we would likely see investors selling US currency in order to retain a certain margin of profit. Due to the influx of US dollars, supply of USD will increase, resulting in a depreciation of the currency relative to AUD as supply exceeds demand.
Hi, my name is Jerry, and from this slide I will be discussing about the determinants of the exchange rate and the prediction of Australia and Japan currency in coming years. The first determinant is the relative inflation rate. As a general rule, a country with consistently lower inflation rate exhibits a rising currency value, as its purchasing power increases relative to other currencies. Countries with higher inflation typically see depreciation in their currency in relation to the currencies of their trading partners. This is also usually accompanied by higher interest rates. Currently, Australia's inflation rate is 1.9% and Japan is 0.4%. Due to Australia's relatively higher inflation rate compared to Japan, we believe that there will be a decrease in demand for Australian dollar as there is less demand for exports. However, demand for imports will increase, thus increasing supply of Australian dollar, as it will be relatively cheaper to purchase goods from Japan. From this graph showing Australia's inflation rate from 2014 to 2017, it is hard to determine if inflation rates will increase or decrease due to its volatile nature shown by previous years. The second determinant I will discuss is the relative interest rate. The current relative interest rate for Australia is 1.5%, whereas Japan is negative 0.1%. Interest rate, inflation, and exchange rates are highly correlated. By manipulating interest rates, central banks exert influence over both inflation and exchange rates, and changing interest rates impact inflation and currency values. Higher interest rates offer lenders in an economy a higher return relative to other countries. Therefore, higher interest rates attract foreign capital and cause the exchange rate to rise. The impact of higher interest rate is mitigated, however, if inflation in the country is much higher than the others, or if additional factors serve to drive the currency down. The opposite relationship exists for decreasing interest rates. That is, lower interest rates tend to decrease exchange rates. This graph from RBA shows that Australian interest rates have been downward sloping from 2010 to 2015, with little to no fluctuation, hitting a historic low, but we believe that the government will start to increase their interest rate from the current 1.5% to 1.75% in the next 3 to 6 months because the current economy has significantly recovered. In conclusion, in the next 3 to 6 months, we would likely see the Australian dollar increase relative to the US dollar due to the greater foreign demand, higher interest rates and high levels of local economic growth. And in reference to Australia and Japan, we will expect a decrease in demand for Australia and an increase in imports in the next 3 to 6 months. Here is our reference list.